Gautam Trivedi, good morning. Thank you for joining us. What should we start with? There are lots of things. Election, jet deal, Z.
Good morning.
DHFL.
DHFL.
I think let's start with really what the rally is all about, and that's something which I think a lot of people seem to be haven't fully understood. So, I was in Asia about 3 weeks ago meeting investors who are active FPIs, FIs into India. And a lot of them who've actually done, some of them have done very well, are still not seeing the flows that you would expect them to see in terms of net inflows into their funds, whether they're India-specific funds or for that matter, Asia long-only funds. And what that means really is that the rally that you've seen this year so far, and a lot of people think this is great for the Indian economy, but the fact of the matter is it's only 7 to 8 stocks that are really pulling the market up, number one. Number two, the other issue I see is that about bulk of the money that's come in has unfortunately or fortunately come in through ETF/passive funds. So as a result, we're not seeing the big flows that we used to see maybe until 2 or 3 years ago, where now passive money is increasingly becoming a big chunk. So I think these are issues to keep in mind, and before people expect the rally to broaden out, I think the quality of the money is important for the rally to broaden out.
Okay, you're talking about the overall setup at the current juncture, but let's delve deeper then. What is the outlook when it comes to IT? We're particularly looking at the kind of commentary that the tech behemoths dole out as well. And, that is going to be closely watched to gauge the sort of demand scenario for IT services, because the global slowdown worries are taking center stage. So what is the outlook that you're expecting from both the tech giants?
I don't want to specifically comment on their quarterly estimates because we don't track that. But the reality is, I think the overall sector really has been a bit of a disappointment. A lot of investors that I speak to, both domestic as well as offshore investors, really think this is becoming increasingly a trading play on the currency versus the fact that the Indian IT companies have actually fundamentally changed the way they conduct business. And the core business of the Indian IT sector, which is services, hasn't really seen great growth. So I think let's wait and see what guidance and what results the big companies give before I actually comment more.
Well, not all that bullish. I think last time when we met, that was again a couple of quarters ago, a couple of weeks ago. So what has changed? I mean, is it liquidity? Is it central bank policy action? And if central bank policy action, Gautam, has changed, it has changed because central banks are feeling negative about the economy. They feel the economy will slow down. So what should equity markets be celebrating? The fact that central bankers have turned cautious, or the fact that if central bankers remain cautious, more money will come? Because 2 and 2 doesn't crack. I mean, how can markets be going higher when there is going to be a contraction in growth and not expansion in earnings?
No, I think the central banks holding back on any further interest rate increases, specifically the US Fed, and domestically, of course, the RBI seems to be in a pretty good mood to cut rates. That usually bodes well for equity markets. I mean, the other aspect to keep in mind is in India, the current rally is an emerging market rally. It's not an India-specific rally. So we're not the best performing market year to date. It's, the Shanghai Composite, the Hang Seng, the Brazil market. So, we are among the top 5, but the fact is this is a very much an emerging market rally that's been caused primarily by the way the central banks have been benign about interest rates. So I think this is something which also is an important element to keep in mind before expecting the rally to start to broaden out.
Gautam, this morning we were just a little taken aback about what the world has to say with regards to some of the auto majors, and especially Tata Motors. One of the global chartists has initiated a 40% upside in the stock, and he's saying that, it's going to head it in for a breakout. Do you believe some of these autos are to be bought in the current decline, or do you think this decline in their sales and demand pressures is going to continue for some more time and we will have better an opportunity to buy into them?
Specifically, if I look at the overall auto space in India, we've seen 10 consecutive months of weak auto sales. But I think increasingly and globally for auto companies, China has become a very important component. So it's a bit like the US box office. It's not just limited now to 10 years ago you would say American Hollywood movies, their performance would be to a great extent impacted by domestic box office receipts. But now it's China. China has become a much bigger market in terms of contribution to the overall global box office receipts for a Hollywood movie. Similarly, for the auto companies, China has become a very important element. So it's really taking a view of where China is going to be 12 months, 24 months from now in terms of its GDP growth. And frankly, if that view is starting to turn positive, then I'd turn positive on auto companies, which includes Tata Motors.
You know, the IL&FS crisis is well behind us, or at least I would like to believe so. Do you think time has come to move beyond the blue chip NBFCs like a Bajaj Finance and start trickling into the tier 2 names too?
I don't think so yet. That's the problem. And I'll tell you where that's stemming from. And I think the central issue here is the exposure which a lot of these NBFCs have and may have not fully shared is their exposure to the real estate sector. Now, the one silver lining on the real estate sector has been the success, and I really mean the big success of the Embassy REIT. I've spoken to a whole bunch of real estate developers in Mumbai, and they're very happy with the way it's been received and the performance thereafter. So as a result, if we see more REITs hitting the market, I think that will significantly bring back a financial improvement in the balance sheets of some of these companies, especially the ones that are in commercial real estate. So as a result, I think there's some hope for the NBFCs, but I'm not sure if it's, I think it's too early to buy them outside of the blue chip names.
Why as a firm, why do you think there's money to be made in cement? Cement stocks are not cheap, and real estate sector is not in a great shape, which means that valuations are not attractive and demand will remain subdued.
Yeah, if you look at the cement sector, it's been probably one of the worst performing sectors in the past 2 years in India. Okay, while the large caps haven't done much, but the mid caps have actually gotten whacked pretty badly, anywhere from 30 to 40% over a 2-year period. Having said that, if I was a foreign institutional investor, because you have to look at both elements of who's going to buy cement stocks, domestic funds as well as FIs. From an FI perspective, I'd rather put money in a cement company in China. Valuations are half, ROEs are double, and EBITDA margins are significantly higher. So I think interest from foreigners into Indian cement companies, I think, will be muted and will continue to remain so as long as they have a choice to put money in cement companies in other EMs. But from a domestic perspective, I see some degree of pricing power come back. But as you said rightly, a lot depends on the revival of the real estate sector, which accounts for anyway 2/3 of the cement demand.
So post-election, Gautam, and assuming the best case scenario for equity markets that the current regime is re-elected, do you still think that the texture of the market would remain same, wherein the broader markets lag behind the benchmarks? Or do you think there is a chance that perhaps the mid and the small caps may see a faster recovery play by?
I see a couple of fundamental issues that are impacting our economy and obviously as a result the market. First and foremost, I think we still have the annual issue of the monsoon, and again SkyMet has said that the monsoon this year will be below average, which clearly is not a positive sign, and I hope they're wrong, but that clearly is not a positive sign. The second element I see is the MSCI increasing the weight of China and reducing that of India. So obviously that will impact flows that are already in India and plus incremental flows coming into India. So I think there are some structural issues. The problem with the economy today is not just limited to these factors, but you've got also other things like the GST rollout, the impact of which has not been fully factored in. You've got the IBC, cleaning up the banks, and again recapitalizing the banks. Is the amount of the amount that's already pumped into them, will that be enough to take credit, non-food credit growth above 10%? I don't know yet. We have to see. And more importantly, private sector capex. I mean, we haven't seen that come back yet. I still think that's easily 12 to 18 months away. So until all these factors don't come together, I don't see the economy necessarily significantly outperforming for the time being. The markets, meanwhile, may act differently, and as they always have. We've seen a great month of March where we saw 11,500 crores come in, which was a big surprise, up significantly up month on month. So if that sustains, and if the money coming in from FI sustain, the market could still behave differently from the underlying economy.
What is the outlook, Gautam, when it comes to individual sector earnings? For the capital goods space, generally we're expecting order flow to aid growth this time around. A broad-based pickup, though, in private capex, that's still awaited. But revenue growth is largely expected to be spearheaded by a strong order backlog. What is your expectations, and are there any opportunities that you see within the sector?
Yeah, I think let me also address, before I answer that, let me also answer the earlier question which I missed out on, which is the mid-cap sector. We've looked at the mid-cap sector very closely because we are essentially a small and mid-cap fund. And what we found is there are certain subsectors within the mid-cap space which are actually facing significant headwinds in terms of significantly more competition. So let's look at, for example, ceramic tiles. Companies that were doing sanitary ware are now jumping into ceramic tiles, and vice versa. If you look at the kitchen appliances space, for example, 5 new companies are now jumping in and trying to leverage their existing brands. I know, for example, a glassware company which is now into kitchen appliances. So I asked the promoter, why would you get into kitchen appliances where you don't have any specific expertise? And he said, we're going to leverage our brand name in glassware to start a business in kitchen appliances. And then you see the innerwear market. I mean, we have seen over 10 to 15 new competitors get into the innerwear space. So margins, I think, over the next 12 to 24 months are going to get significantly squeezed in this. And the other, of course, business I forgot to mention that what we believe is really is going to become a very competitive business is the retail in the semi-urban and rural areas, which was until now dominated by a Vishal Retail, V-Mart and V2. On last count, we've seen a total of 15 new competitors who are starting off with UP, Bihar and Madhya Pradesh, but are now branching out into the rest of India. So the competition in that segment, again, very mid-cap dominated, is again going to intensify. So we're really starting to get concerned about opportunities within the mid-cap space, especially with competition intensifying in a lot of these subsectors, as I mentioned.
Lovely chatting with you. Thanks much for joining in and giving us your view on individual sectors as well as your outlook for the markets.
Thank you.